Hello student. Today we will be discussing the audit of banks. Audit of banks, what we are going to discuss in that one? Basically, the process of auditing is exactly the same as you have already discussed. It is same for all the type of organization, whether it's a bank, insurance company, cooperative societies or companies, manufacturing, trading. But here what we will be discussing in these specific chapters of the special attention will be given to the knowledge of that particular business. We will also be discussing that what are the relevant regulations for that particular type of audits. And as far as the documentation is concerned, the other processes are concerned, that is the same as you have already discussed. Now that today when we will be discussing this audit of banks, we must know that what is the scenario in India. In India, we have a different types of banks. They are commercial banks, they are regional rural banks, they are cooperative banks, and they are development banks. These all types of banks, whether they are commercial banks, commercial bank you must be seeing that you have around 27 public sector banks. Take a case of State Bank of India, you have a Bank of Baroda, Canara Bank, all these are public sector banks and they are the commercial banks. Regional rural banks to help the rural economy, the government has set up a regional rural banks and they are basically in the rurals, in the agriculture sectors. There are cooperative banks. As per the cooperative acts, they may be registered as a state cooperatives or the central cooperatives, and there are development banks. You must have heard the name of IDBI, Industrial Development Bank. There may be industrial finance corporations like this, which are giving a long-term loan for the projects. Nowadays, that thing has, these such type of development banks are almost eliminated, and they have converted themselves in the commercial banks, commercial activities. So these are the different types of the banks. Use just a background for you. And what is the legal framework for these banks? Legal framework, there is a One Banking Regulations Act 1949, which governs the banks, all banks. There is a State Bank of India Act 1955, a specific act for the State Bank and subsidiaries, and there is another act for these subsidiaries, associate banks of the State Bank of India. There are Companies Act. Most of the private sector banks, like you are saying the Indus Bank, Axis Bank, these all banks are registered under the Companies Act 1956 and they have got a license from the Reserve Bank of India. So they are regulated basically from the Banking Regulations Act, but this Companies Act also applied to these banks. Banking Regulation Act, maybe because of its specificness, it is a specific act for the banking business, and therefore the Banking Regulations Act supersedes all other acts if there is a conflict between those acts. We have a Banking Companies Acquisition and Transfer Undertaking Act 1970 and the 1980. And this act was passed at the time when the nationalization of these banks was done, and these all public sector banks are covered by these two Banking Companies Acquisition and Transfer Undertaking Act. And there are Regional Rural Banks Act 1976, where the regional rural banks are covered. So these are the somewhat a legal framework for these banks. Now there are some other some other acts which are relevant for the banks. They are Information Technology Act 2000. You must be studying this act in your corporate law paper. And you have a Prevention of Money Laundering Act 2002 that applies that is relevant for the banking sectors. Securitization and Reconstruction of Financial Assets Information Security Act and that is when the bank take a acquisition of the securities against when if the borrower is not paying the advances, and then they resort to this act for acquisition of those securities. Interest Act is there, that's not relevant nowadays. Credit Information Companies Regulations Act 2005, there you must have heard the name of CIBIL, that is the organizations which gives a credit informations of the borrowers to these banks. They can access to this website of the CIBIL, and they can know what is the credit worthiness of the borrowers from there. Payment and Settlement System Act, for this whole the payment, the interbank settlements and the checks transfers, and all these are guided by this act. So these are somewhat a relevant act. Now, when we are talking about the audit of the banks, what we have to audit? We are auditing their financial statement. And what are the financial statement in case of the banks? The financial statement are the same as we have in the companies. They are balance sheet, profit and loss statement, cash flows. But their formats are different than the Companies Act because they are regulated. These formats are given under the Banking Regulations Act. There is a section 29 there, and under that section there are the formats of balance sheet, format of profit or loss statement, and as far as the cash flows is concerned, that is prepared as per the accounting standard 3. So you have a formats, and we have to audit, and when we are auditing the banks, we have to consider those formats, because the auditors also gives the report that the financial statement have been prepared as per the Banking Regulations Act. All banks, whether they are state bank, other commercial banks, regional rural banks, cooperative banks, they are preparing the balance sheet as per those format prescribed under the Banking Regulations Act. The Banking Regulations Act and other acts of State Bank of India Act, all these they prescribe for the audit of the banks by a chartered accountant. So that's the provisions of audits in the banks. Now we come to the what basically we do in the bank audits. As I told you that, in fact, we are not talking about here about the audit process. We are talking about more about the knowledge of business. What exactly is the terms which are being used in the banks, and what are more important from the banking point of view, because there are very technical terms in the banks, and we will be explaining those terms. They have a different income recognitions and asset recognition norms, and we will be discussing those norms here. And they have a different reporting, just like in a bank, in the company there is a CARO report, here it is a LFAR report, long form audit reports. We will be discussing that one also. Now, one of the most important point and more ingredient of the bank audit is a capital adequacy measures. When you talk about the capital adequacy, this is relevant only for the head office of the banks, this not for the branches. From the branches they may be collecting informations, but this capital adequacy is practiced, and you will be doing the audit of that capital adequacy in case of only that when you are the central and head office auditor of the banks. Now the question is that what is capital adequacy? What is capital adequacy? You see, the simple meaning of the capital adequacy is that every bank must maintain adequate capital. Adequate capital means which is sufficient to discharge its liabilities. So, what is that adequate capital? Is there any absolute amount for it, or they have prescribed some relative amount for it? As you know that these banks takes the deposits from the public, and the RBI, who is the regulator of these banks, has to ensure that the whatever deposits they have taken from the publics, that is repaid to the depositors. And there should not be any situation that bank capital falls, it is less than what it has got a liabilities. So that basically, because these banks are taking a deposits from the public, they are advancing out of that money to the borrowers. Now, if the borrowers does not give the money, then bank may say that they receive a deposits of 500 crores, they have advanced to the borrowers, the people who took a loan from the bank for 100 crores, and those borrowers didn't pay the money of 400 crores, didn't make a repayment of the loan. Then what will happen to those depositors? In that, just for the protections of that one, the Reserve Bank of India, which is the regulatory authority for these all banks, has prescribed a capital adequacy measure. And what is the capital adequacy measure? As I told you, the simple definition is that every bank must maintain adequate capital. And what is the adequate capital? Whether 100 crores, 200 crores, 500 crores is adequate capital? Can we fix a certain absolute amount of adequate capital? The answer is no, because it will depend upon that how much deposits that bank has given, how much advances that bank has given, and what types of advances it has given. Whether it has given advances to all advances to the very risky sectors like power, like a real estate, and if you have given you have given an advances to the most reputed companies of trading companies or manufacturing companies, and where there is no risk at all. So if you give advances to more risky sectors, you may require more capital, because the chances that those lending and advances are turned bad, they become doubtful, or there is a non-recovery of that advances are more if you have given the advances to more risky sectors. The chances of recoveries are very good if the advances are not given to the risky sectors. So the banks which has given the advances to the risky sectors like a real estate, power sectors, or some infrastructure sectors, they may require more money, because they have to pay back the liabilities of the depositors, and in the event that they don't get a repayment of the loan, still they have to pay the depositors' liabilities. There is another bank which has got a 500 crores of deposits, and it has made an advance to all very good sectors like FMCG sectors, and there is no bad debts in that case. So it may be requiring a less capital. The point what I want to tell you that there is no absolute amount for the capital. What is adequate capital? No absolute amount. And therefore there is a relative amount of the how much should be the capital of a particular bank. It depends upon the portfolio of its assets, whether they are risky or less risky or no risk. So all things depends upon the risk portfolio of that bank. So that is the relativeness. If any banks has a more risky portfolio of advances or other assets of investments, then it will require more capital in absolute amount. If the banks had put all these advances in a very good sectors, which is not a risky sector, it may require a less capital. So it's a relativeness with the risk of the assets of that bank. And therefore, the RBI, the RBI, RBI has prescribed the capital adequacy ratio for all the banks. Capital adequacy ratio. And what is that capital adequacy ratio? It says the computation of capital adequacy ratio is done as capital fund. You can say capital fund just like any other capitals. Divided by risk weighted assets and off balance sheet items multiplied by 100. So these are the way the capital adequacy ratio is calculated. And the capital adequacy ratio for the banks as prescribed by the Reserve Bank of India is 9%. And what is this capital fund is? Capital fund consists of two types of components. One is called tier 1 capital, another is a tier 2 capital. The tier 1 capital basically is a paid up capital and reserves and surplus. Tier 2 capital consists of the certain reserves, subordinated debts, long term debts, preferential capitals. They are in the tier 2 capital. And the combination of both is called a capital fund. And if you divide by the risk weighted assets by the risk, then that will give, and the answer should be the computation, the result must be more than 9%. And if it is less than 9%, means the bank is not complying with the capital adequacy requirements. Dear student, this is the ratio which is very important in case of the banks. While auditing the financial statement of the banks, the auditor has to give a more attention to the capital adequacy ratio. Because if somebody says to you that what types of bank it is, so you should look the capital adequacy ratio of that bank. That will give you a summarize positions, financial health of that bank. If the capital adequacy ratio in one bank is 12%, in another bank is 16%, the bank which has got a capital adequacy ratio of 16% is a sound bank, financially sound bank. If it has got a capital adequacy ratio of suppose 8, it is not a sound, financially sound banks. So financial health of the banks can be measured by capital adequacy, and this is a very important ratio in the banks. The central auditors or the bank auditors has to pay a very great attention to the computations, whether these computations of this capital adequacy ratio has been done correctly or not, because that is one of the ratios which gives a summarized view, or that's the one ratio which gives the indication about the health of the particular bank. Dear student, when we talk about the capital fund, I told you that consists of tier 1 capital and tier 2 capital. When you talk about the risk weighted assets in the denominators, in the banks there are three types of risk. One is called a credit risk, another is called a market risk, and third risk is a operating risk. And when we talk about the risk weighted assets, these all risks are combined. All risks are combined, and then the capital fund is divided by that risk. There are some off balance sheet items in the banks also. The banks have given a guarantees. These are off balance sheet items. They have issued a comfort letters on behalf of its customers. They are all off balance sheet items. There are a number of balance sheet items. You must have done it in your IPCC paper. The risk weight of all those off balance sheet items is also taken into consideration. In India nowadays, the banks are computing their capital adequacy ratio as per the Basel II formula. Basel II. The Basel is the place in the one of the country in the Europe where all these banking capital adequacies were discussed, and after that they formulated one Basel II. And nowadays the banks are computing